Hello, fellow investors, and welcome to another episode of Ritter on Real Estate, where we teach you how to passively invest like a pro. Today, my guest is Axel Ragnarsson. He's an active real estate investor based in Boston, Massachusetts. He's been a full-time real estate investor since 2017, and he's the founder of Aligned Real Estate Partners. They acquire and operate multifamily properties throughout New Hampshire, Rhode Island, and Florida. And currently, Aligned either directly owns or is a general partner in over 550 units and is a principal party in over 90 million in transactions. And so thanks for coming on today, Axel. How you doing?
I'm doing great, Ken. Appreciate it.
Yeah, I'm excited to talk with you today. You know, you're in some markets that we don't hear about too often. You know, everybody's hot on the Sun Belt and what's going on, you know, Southwest, and now even the Midwest where I live has hit the radar of everyone, right? But Northeast is maybe a sleeper market that we should learn a little bit more about. And so, but before we get into all that, let's start at the top. Tell us a little more, Axel, about, you know, who you are and how you got to be where you are today.
Yeah, so you mentioned Northeast. I'm a New England guy, born and raised in New Hampshire originally, which those who are not from New England probably are just finding out that New Hampshire is a state that even exists. But for geographic references, about an hour north of Boston is where I grew up. Went to college in New Hampshire and then moved down to Boston. But while I was in college, the way that I'd actually make money, I've never really been an employable guy, I think, to put it mildly. I've always liked kind of working for myself. I was buying and selling cars as a way to make money in college. And I was getting towards the end of college thinking about what comes next. You know, am I going to get a job? Can I start a business? What's going to happen? And somehow I found real estate. I forget how it happened. It might have been HGTV or something like that, or an Instagram ad, you know, how to flip houses. Whatever it was, I started discovering real estate investing, specifically through the lens of flipping houses. I was like, oh yeah, that's what I'm going to go do. I'm going to finish school. I'm going to go and figure out how to buy, fix up, and sell houses. So this is back in 2015, 2016. You know, around this time, I'm finding resources like Bigger Pockets and just other podcasts, YouTube videos, stuff like that. And while I'm learning about how to flip houses, I'm learning about rental real estate. Like, I'm now becoming exposed to that and the idea of cash flow and passive income. And I pretty quickly realized, like, that's actually a better trade, in my opinion, right? You go out there, you find a good deal, buy it at the right price, you fix it up, maybe pull a good chunk of your money out, and now you've got cash flow coming in. So I said, hey, that's what I want to go try to figure out how to do here. So after college, I started buying small multifamily properties, was doing a lot of 2 to 4 unit deals, the Burr method, right? That's what Bigger Pockets popularized back in the day. Mm-hmm. We're buying really good deals at below market value. We're fixing them up. Maybe we're using private hard money, some seller financing. We're refinancing and pulling our money back out, you know, with a local bank or something like that. In order to do that, you got to find great deals. So I spent a lot of my time figuring out how to go direct to seller. Spent a lot of time sending direct mail, making cold calls, all of that. And from 2016 to 2020, built a portfolio of multifamily properties, you know, small multifamily properties that I owned. Very quickly realized that I needed to bring in other folks if I wanted to, like, scale the business and actually create a real business there. I was going to be capped in terms of the amount of deals I could do each year just with my own resources. And started working with some partners, like very simple 50-50 partnerships with other investors I knew in my market, you know, that allowed me to do more deals each year, do slightly bigger deals. As I started partnering with other folks, I learned about actually raising money from LPs. And this is now kind of early COVID, like 2020, 2021 timeframe. And along the way there, we started actually, you know, raising money in the traditional sense to buy deals, as I'm sure many of the folks are familiar with who are listening, and in terms of what you talk about, Kent, on the podcast. Raising money from retail LPs, you know, 50K, 100K checks to kind of monetize our deal flow. So still doing some deals myself, but now we can do more deals, and now we're pouring gas on the direct to seller fire, so to speak, and we're able to buy more of the deals that we actually found. And that's really evolved into what the business has become today. We're very, very focused. You know, we did deviate in 2021 and do a few deals down in Florida, a few of which we sold and did really well on, and one of which we still own. But now we've kind of brought it back to 90% of the deals that we do are in New Hampshire. We do a little bit down in Rhode Island, about an hour south of Boston, but 90% of what we do is in New Hampshire. We probably buy 15, 20 deals a year that are kind of small to mid-size multifamily deals, 5 to 50 units. And we raise money from LPs to buy them. Along the way, we started a management company as well, and a whole bunch of fun stuff in terms of what we learned doing that. But that brings us to 2025 here today.
Gotcha. I mean, a lot to unpack there, kind of the shift from flipping single family, right, into multi, building out a management business, right, and kind of doing this in a different way than a lot of folks have attacked it, which is kind of try to buy bigger properties. You guys really have niched down, kind of staying in that 5 to 20 unit sweet spot, it sounds like. So, I mean, it's interesting. And I think a lot to learn from. Love hearing different strategies. Talk though about your transition from, a lot of us started flipping houses because like you said, HGTV was out there and this is what you learned about. But talk about that transition from flipping into multifamily. What was it that attracted you into more multifamily properties?
Yeah, I think it was a couple things. The first deal I did was a 3-unit deal that I found for sale by owner on Craigslist. So my first deal was a multifamily, but at the time I was still trying to flip houses because I was like, I need to generate cash to go out there and buy multis with. I did a few house flips early, and what I quickly realized was my skill set is in the finding great deals and creatively structuring them with private money or seller financing or, creative debt of some kind. And it's not being a construction manager, and it's not design, and it's not, putting together a nice house for somebody who's going to go out there and buy it. Right. So I had a few flips that just went sideways for no other reason other than I was just a dummy and I just didn't do a very good job at it. Right. I think at that time too, I had moved down to Boston at that time, and I'm now investing up in New Hampshire, an hour north. I'm not on site on some of those flips every day with, the GCs that I hired, and I hired the wrong ones to begin with. And it was just like deals that were dragging. I wasn't making any money. And I quickly realized, like, if you're going to go and do some type of, manage any type of construction, like do so on a small scale. Like renovating an apartment is an entirely different process than renovating an entire 3-bed, 3-bath single family home, for example. We're just taking the cabinets off, we're putting the cabinets back on. Like we're not really splitting the atom here when we're renovating an apartment. So I quickly realized, like, hey, your skill set is finding great deals. Just go find the multifamily ones, manage some simple construction, and then, pull your money out in 6 months after you've really created that value as a result of buying at the right price and creating the value through operations post-close. And I just realized that was a better fit for what I was trying to do. And the other piece of it was, I didn't want to be in a position where if I just stopped working, I had nothing coming in, right? Just at its most fundamental level. I was like, if I want to spend my time building something, any type of business, I want to be able to just stop and assets are left, right? House flipping is a job. You have no residual value in a house flipping business. You can't sell that business to somebody else. Yeah, maybe you keep some as rentals, but if you're flipping everything, it's a high income earning job. It's not tax advantaged whatsoever. And when you stop doing it, you stop making money. You can make a lot of money, but you have to work for it, right? So for me, I was like, I want to go out there and build a portfolio that then I can stop working that'll pay me if I decide to do so.
I got you. So it sounds like 1, it was alignment with your skill set. 2, and it was just creating some passive income for yourself, right? Yeah, that realization that you're working for a living if you're flipping houses, and as soon as you stop working, the money stops coming in. Yeah,
100%. Yeah, and the big thing is the first one. Just wasn't good at it. That's the easiest answer. I was not a good construction manager. That was not my skill set.
Hey, yeah, there's something about knowing your strengths and leaning into them. Yep. So that's interesting, right? But you've really kind of stayed in this, what I would call smaller multifamily space, right? You're 15 to 20 units, maybe a few bigger than that. So tell us what really draws you to that space versus you hear from a lot of people, right? You got to go bigger. You got to go 100 plus units. What keeps you in that space and that focus versus kind of following the crowd, if you will?
Yeah, I think it's a good question, and I struggle with it myself in terms of what our focus should be internally. But the way that I view it is, 1, we have to give what our markets we have to take what our market's giving us. And that's kind of what guides a lot of what we're doing in the respect that New Hampshire is a small geographic area, right? Biggest city in New Hampshire is Manchester, New Hampshire, 125,000 people. That's the biggest city in the state. The southern region of New Hampshire, where we primarily invest, 500,000 people, maybe 600,000, when we spread it across everywhere that we're looking. It's basically like the size of like one mid-sized metro, in terms of like if you were looking in in another state at one of the larger cities in that state. So for us, that's a big dynamic where we would like to purely focus on larger deals. And we still occasionally do a larger deal, which I'll define as like $10 million plus. Like, we got a 72 unit. We've bought some 80, 90 unit portfolios. But those are like maybe once a year we're doing that. And if we only focus on those types of deals, well, we're going to do one deal a year because that's all that the market's giving us in terms of the size of the pond that we're playing in. So in my mind, I'm okay with continually doing these smaller deals because we have a great engine to find discounted opportunities, right? We send a lot of mail. I got a full-time acquisitions guy. We find a lot of 10, 15, 20 unit deals or portfolios where maybe we're paying $1.5 million and it's worth 175 when we close. And the actual dollars that we're generating there are meaningful enough for us in our business to still pursue those. The challenge became as we started raising money is how do you raise money for those? Because there are challenges with raising individually for these smaller deals. We found some ways around that, but we still want to do these big deals. I'm sure I'll probably get to the point to where like I'm a little burnt out on the kind of the high volume deal approach of running a business. And maybe we just settle into doing 3 deals a year that are a little bit larger, 7,500, 150 units as the business matures. But right now, we still have a lot of opportunity in that smaller space, so we still capitalize on it. And I think that what'll end up happening down the road is maybe we're expanding into a few different geographic areas, increasing the lower end of the threshold of what we want to pursue. And that might be, that may be where we end up sometime in the future. But right now, we're still taking the opportunities that comes to us, which is oftentimes in that smaller sector of the marketplace there.
I gotcha. And how many units do you guys have in total?
Yeah, so we own and operate right now right around 500 units. And then our PM company, which is another line of business that we have, we manage about 800 units. So we've got mine and then a few hundred third party as well.
Gotcha. Because one of the things we always talk about in the size, so you get these economies of scale, right? And there's a lot of cost savings and benefits, efficiencies that can come. But see, it sounds like you guys are achieving a similar. You're achieving it in just a different way, right? You've got 500 or even 800 units under your management. I'm sure you guys are able to do, spread maintenance, spread management, spread costs among that whole portfolio. And that allows you to bring in these smaller properties into the ecosystem. Is that right?
Yeah, that's absolutely right. I think, the vast majority of the properties that we own are within like a 20 to 30 minute radius. Mm-hmm. Most of it's kind of like 15, 20 minutes, right? And like this little centralized area and a couple of cities that are bordering each other. And for us, we've got a lot of these 5, 8, 12, 20 unit properties kind of scattered around. But what we found is that we can do a lot behind the scenes with tech to optimize the scattered site nature of the management process. We leverage a lot of stuff like self-showings, remote team members to take inbound calls, whether it's leasing or, tenant relationship type work or conversations, I should say. Really the only tough part from a US based standpoint is like we got our maintenance guys, we got our property managers that are kind of running around and looking at stuff and a leasing agent that kind of supplements what we do on the self-showing side. And it's like, yeah, there's some space in between the properties that they're going to, and it's not necessarily as efficient as having somebody on site. But we still make do with a lot of the technological resources that are available to us. And I also think that at the end of the day, so much of what we talk about is kind of priced in to what you pay as an investor. I think if you're pursuing a large multifamily property that benefits from those economies of scale of having somebody on site, you're probably competing with more sophisticated buyers. You're probably dealing with a more sophisticated seller. The debt is in a tighter range for a lot of those deals, right? So, having an advantageous relationship on the lending side isn't as valuable as for say if you're pursuing a 10 or a 15 unit deal. And for us, we find so much inefficiency in that market because it's such a fragmented group of folks who pursue those deals. It's a lot of small local mom and pop folks. Maybe you get a sophisticated guy down in Boston heading up to New Hampshire to buy some, but then he realizes, I don't want to buy 20 units. What am I going to do? Bring it to a third party company too small for me to afford my own guy up there to manage it. Mm-hmm. So we capitalize on a lot of the inefficiency in that range. And we've really built a management infrastructure that does the best that we can possibly do with the nature of a portfolio like that, so we can still capitalize on those deals.
Yeah, that's interesting. You've kind of built the best mousetrap for this type of portfolio, right? And you mentioned you leverage a lot of technology to do that. Curious, what are some of the key pieces of technology, and like how have you implemented them to make you guys more efficient?
Yeah, the big one is self-showing when you've got a scattered site portfolio. Tenant Turner is what we use as our showing software. A lot of people get really spooked when they hear self-showings. They're like, what happens if they go in and trash it or they don't leave? And it's like, valid concern. We do everything we can to mitigate against that. You got to upload a picture of your ID. You got to throw in your credit card. We're going to grab a lot of information from you before we even give you the access instructions to get to the unit. Mm-hmm. Our leasing agent spends 1 day a week doing assisted showings at all of our different properties. And then the other days she's going around and making sure all the other ones are showing well. Now I'm nerding out, but we sacrifice a little bit of the conversion percentage in terms of showings to applications because, we don't have someone there to sell the building in the neighborhood, but we make up for that in sheer volume of showings, right? We do a lot of C-class investing. These people are not looking to tour apartments during business hours, predominantly speaking. Our leasing agent works 9 to 5, but Joe, who wants to go and tour the apartment, might only be able to do so at 7 p.m. or noon on a Saturday. So self-showings allows people to go there 24/7, right? And we capitalize on that in terms of now we're doing far more showings in a short period of time. So that's a big one for us. We use a lot of automation software behind the scenes that automate a lot of the key business functions within our PM company. Lead Simple is a really big one that integrates with AppFolio where, for example, accepted application, automated sequence of leases sent out, leases auto-populated. When we don't get a response from the applicant in terms of like signing a lease or what their desired move-in date is, automated task goes to our RTM who's handling all of handling the process around converting applications into leases. And we leverage a lot of that to try to reduce the man hours associated with a lot of the key business functions. Property Meld is what we use for kind of virtual maintenance as our virtual maintenance call center. So we do a lot of that stuff. I'm actually forgetting the name of the software we use for interfacing with our GCs that handle unit turns, but automated reminders to upload progress pics on our unit turns so that our project manager doesn't have to go drive it every single day, but there's automated processes behind the scenes to collect progress pictures from our GCs on our unit turns. AppFolio is great with a lot of stuff too. I'm a big fan of AppFolio. And there's a lot of AI functionality there that we're starting to leverage, like Lisa, the AI assistant, in terms of like helping with showing inquiries, or I should say, leasing inquiries, leasing questions. That's starting to become pretty automated with like AI chatbots and stuff like that helps you kind of manage those initial conversations. So that's a lot,
I'm
but
curious.
That's a handful of what we do. Yeah.
No, I love that. I love how you guys are using these tools to, again, kind of get that scale. I'm curious on the AI front, because obviously that's a big buzz right now. And I think there's a lot of applications in real estate, in multifamily. Dig into that a little bit more on some of the things you're starting to see and where you're seeing value.
Yeah, I think a lot of it early was like fluff. I think up until like very recently, like there was a lot of conversation around, wow, AI is changing everything we do. And I'm like, it didn't really change that much around what we do. Until conversational AI got to the point to where, wow, you can have a conversation with an AI agent or bot and have a lot of thorough questions answered. When we think about like what a lot of the calls a property management company gets are about, it's predominantly leasing, frankly. It's like, hey, do you allow dogs at this unit? Yeah, it's in the description. Nobody reads the description. A lot of people just call, right? Do you allow dogs? Like, I only have half a security deposit amount. Does that work? Or can I do a 18-month lease instead of a 12-month lease? Like all of these different leasing questions are so predominantly what the phone calls a PM company are getting are about. It's very rarely like tenants talking about other tenants. Usually that's via email or text or something like that. They're going to text your platform like, hey, the plow just didn't do this area. Some are going to call, but a lot of that's going to be through your property management software. Once you get them in your unit, and you've trained them up on how to interact with you. But before that, it's a lot of leasing stuff. So what we've done is created some interactive leasing chatbots where we upload hundreds of questions that are frequently received. And a lot of it is more general to our business in terms of what's the minimum credit score. Like that's something that's going to be the same regardless of it's 123 Main Street or 456 Main Street, right? That's not going to be specific to a unit. A lot of that stuff's like, hey, just ask it a question. We'll spit out an answer. Does that completely reduce the phone calls you receive? Not quite, because a lot of people just want to get on the phone and talk with a human being, which, I mean, I'm one of those people. Like I prefer to do that versus interact with some type of AI bot. That said, it just cuts it down at a percentage that's high enough to where instead of needing 3 individuals in your business for 800 units to answer phone calls live, maybe you just need 1 or 1.5, and that other half person can do something else, and you're lowering your labor cost. That's where we've actually seen some level of return there. You know, I think we do a lot of stuff with like training, where, you know, we have our knowledge base for our business that we store in Notion, right? And like, it's just every single system and process within our business. You can just type into the AI in Notion, like, if you're a new employee within our business, how do I, draft a listing description? If you're somebody who's like an assistant leasing agent, bang, takes you right to it. AI spits out in like plain English exactly what you got to do. So it makes our knowledge base and our company kind of wiki, as we call it, like much more useful and accessible. A lot of the AI that's integrated into Notion. So there's some uses like that. But I think in terms of like what saves the company money and is like a real material difference, I think the conversational AI is getting to a point to where that's starting to become pretty game changing and meaningful for us.
I agree. I mean, we've been looking at some of these applications as well, and we're working on implementing some on the leasing side. And I mean, some of these conversations you can have now, I mean, I've tested it out, right? You call in and you're talking to this AI and you can still tell, but it's not enough that I really care anymore. You know, you can still get answers.
You can get it answered. Yeah.
And so it is pretty incredible. And like you hear the stats from some of these case studies that have been done, and it's like where companies can go and really answer 80 to 90% of, like you said, the very simple questions that are repetitive over and over again, and the ability to really scale that, right? And allow your folks to focus on higher priority items, right? I think is the end goal. And so I think AI is really going to be extremely impactful for property management. When you think about the ability to send collection notices, right? Like if notices don't go out because somebody forgot or didn't have time, then that moves the whole process back, right? And delays payment. And we know that people are taking longer to pay than they have before. Like I've seen the stats. It's like, but if your AI can send 1 million notices out at one time in 1 second, and it's programmed on how to do that, I mean, it's just game changing from a volume standpoint. And those are some of the ways that we're looking at it on how to just, like you said, get rid of some of these administrative tasks, let people focus on higher priorities.
Yeah, no, it's the same thing in our business. And then, you know, just another use case that comes to mind here is when we're renovating apartments or we're looking at I should even back up. When we're looking at a building on the acquisition side, and we're like, what would this look like with this new paint for the siding? What would these units look like with these finishes? The AI has gotten to the point where you can take a picture of anything, give it a prompt. I want it to, you know, change the siding color to X, make it vinyl, change the roof to a beige shingle instead of a black shingle, whatever it might be. Like you're getting like really accurate renderings of everything that you do. A lot of that's changed how we communicate with lenders, with investors when we're raising capital for deals. And then specific to property management, if we're trying to stage a unit, like staging used to be like a bit of you could do a virtual staging and it would cost some money. You know, maybe you're spending 10, 15, 20 bucks per unit to kind of virtually stage. And this is like in years past. You can do that really easily now with a lot of the Google imaging AI. I think it's like Nano Banano, I think is the new one that just dropped like yesterday. If I'm saying that wrong, I'm really embarrassing myself. This is literally like the last 2 days. It's something like that. But you can upload pictures of an apartment and just say, you know, hey, virtually stage this. And it looks incredible. It's like such a higher level of any version of that in the past. So we're using a lot of different AI tools to do stuff like that, where we're staging units. Or if we're in process of doing construction on a unit, it's like we can upload pictures of a unit that's demoed and say, finish it with these finishes. Then we include in the listing description, like, hey, under construction, this is what it's going to look like when it's done. it's staged, what have you, right? So we can generate a little bit more interest when we're leasing. So there's some like
Very
little
cool
edge cases that you can use like that as well.
Yeah, I love that. That's really interesting on hearing how you're staging and using it to show kind of after finishes and things like that.
Yeah.
Well, Axel, one thing that stuck out to me is just the locations and where you're investing, right? We talked about that at the beginning. We talked about how Northeast just isn't a focus for, a lot of the news we hear. But so I'm curious around your market selection. Like, how are you choosing markets? How did you choose the market you're in and to really stick in the Northeast? And what are you seeing in that market?
Yeah, it's fun having these conversations because a lot of our LPs are outside of New England. And they're like, dude, what? Like New Hampshire? Like what's the case for it? Right. And as you mentioned, Northeast is not covered a lot, broadly speaking, in real estate news other than people are leaving the Northeast, right? It's typically only negatively covered. People are moving out of Boston, they're moving out of Massachusetts, they're moving out of New York, et cetera. It's true. There is, broadly speaking, declining population in those areas. And then you have the massive growth metrics of Texas, the Southeast, down into the Southwest, right? Phoenix being, or I should say Arizona being a big one. And all the capital flow to those markets, all being, hyperbole, but so much capital flowed to those markets in that 2018 kind of to 2022 timeframe, as a lot of those demand drivers were really ratcheted up. New Hampshire is interesting in that it does have positive population growth. It's the only state in the entire Northeast United States, which includes Maine, Vermont, Massachusetts, Connecticut, Rhode Island, New York. Like all of these states, New Hampshire is the only one with positive population growth. Some reasons why: no state income tax, no sales tax. It's a beautiful state. It's a lower cost of living. It's very business friendly. And a lot of people are moving out of, for example, like the Boston area, right? We got 1 million people in this metro, and it's a really high cost of living city and region of the country. Let's go head up, 45 minutes, an hour north up into New Hampshire. We're still getting a lot of the value of living in New England, but we're paying a fraction of the price. Now, outside of that, because that's the boring stuff, right? The data and the metrics, all that stuff is relatively boring and stuff you can look up. The reason why we like being in a market like New Hampshire is I'm a big believer in that real, true outsized returns in real estate are made by capitalizing on inefficiency. And we think about efficiency as a spectrum, right? The highest likelihood in terms of finding a great real estate deal, right? Where you buy the $1 million deal for round numbers for $800,000 and you earn this nice big margin the day that you close by paying below market price. It's much easier to do that in an area that has less transactions, where there are less data points, therefore leading to a higher likelihood of mispricings. That's typically going to be a smaller market in terms of the number of deals, the population, et cetera. Tertiary markets is like the easy kind of buzzword that we can use to describe a market like that. And then we also want to be in a size range where we're competing with less sophisticated folks, which we already kind of talked about in terms of why we look for these like small to mid-sized deals. So we talked about that. Now let's talk about the market. Other end of this spectrum, from the tertiary, not a lot of trades, easier to find that discounted deal, whether it's direct to seller or you got a broker who's not that experienced, misprices the deal, you get a good one. Other end of that spectrum is a really efficient market. It's a larger metro with a lot of trades, with a lot of sophisticated players investing in it. Dallas, Tampa, like whatever. We can throw 1 million cities out as examples for that. So for us, we're still a relatively new business. I've been investing for almost a decade now, but like it's really only been the last 3-4 years that we've been raising capital from LPs. And the first 2 years in that stretch were like, it was very small scale. I maybe raised like a couple $1 million. It's really been the last couple of years that we've really grown what we're doing from an investor standpoint and raised any meaningful amount of money. We've raised probably $15 million. The majority of that's the last couple of years. We're still very much in the mode of like, we got to deliver great returns. We got to deliver outsized returns so that we're getting the second bite at the apple with all these investors. We show them a great experience on the investor relations side. We earn great returns, which is fundamentally the most important, component of our job as a sponsor of real estate. And they want to come back for the second one. So for us, it's like, yeah, New Hampshire, a little bit of a harder market to sell to an investor. We at least have the good story of, we got positive population growth. It's supply constrained. We maintain high occupancy, which is a real dynamic in the Northeast. And same thing with the Midwest where you guys are operating, right? There's not a lot of supply. So any level of population growth typically keeps rents moving in an upward direction, where you have all this population growth in the Southeast, but you got so much supply that's been built to meet it, and in a lot of these cases exceed it in places like Nashville or Austin, for example. So we got this population growth, we got supply constrained type dynamics, and we're also playing in a pretty fragmented, inefficient area, which makes it much easier for us as really entrenched investors in this little area to find that inefficiency and to capitalize on it, which flows downstream to an LP who's a little bit more de-risk on the buy side and making a little bit more money on the back end when we actually go out there and sell.
Yeah, I mean, I get what you're saying, especially in the Midwest in relation to the supply constraint. I mean, that's really the central part of our thesis is invest in supply constrained markets, right? Because as you said, it doesn't take a lot of demand growth if supply is not growing to really push rents. And you don't have the cyclical nature of some of these other markets. And so, I mean, I absolutely hear you there. And I think that's a great thesis. And then I totally understand what you're saying on the inefficiencies of the market, kind of in the smaller properties. You find mispricing. You just find guys that don't do this every day. It's all they do, right? As sophisticated buyers and sellers and even brokers at that smaller scale. And so you find some hidden gems. And I think in that, and just like some of the smaller properties that we've had, you can get some really amazing returns in that size because of that kind of mispricing. But I think you also, like in my experience, is you're balancing that with a certain level of risk in having a smaller property. If you have 5 units and you lose one tenant, you're 80% occupied, right? And so how do you kind of manage the overall return with that risk profile of just, you've got less people to spread the risk around, right? Less units and things like that. How do you guys kind of look at that as you approach your investments?
Yeah, it's a good note, right? And it is the downside of what we're talking about where, your vacancy rate as a percentage is much higher when you get a tenant who moves out of your 8-unit building, right? Than having a couple move out of an 80-unit building. Mm-hmm. We kind of deal with that in a couple different ways. One, we've just built an engine of being able to source direct to seller discounted deals at prices that really compensate for back end risk, or vacancy risk. And then, just risk that we might experience during the hold period. Like we're able to buy a 6-unit building that maybe would trade for $1 million. Like that's kind of the pricing in our market. Stuff sells for 140 to 190 a unit typically. Maybe it would sell for $1 million. We're buying it for 800, right? And you capture so much downside protection at the buy when you're doing that. The other piece of it, and this is a little bit more prevalent, I think a little bit more useful, is we try to package as many individual properties as we can into one raise from an LP standpoint as we possibly can. So a lot of our raises historically have been, maybe we have a collection of these smaller properties that individually, if we were to buy them, we would be carrying a lot more of that vacancy risk. But now we're buying 28 units and it's, 5 buildings, a few 5 units, couple 7 units, whatever it might be. And we're putting together a little bit more of a, kind of scaled portfolio. And we're not talking a lot of units here, but we're trying to reduce that risk a little bit. And what we've leveraged the last couple of years predominantly to raise capital is a fund structure where, hey, do you like what we're doing here? Do you like New Hampshire? You like our direct to seller pipeline? We manage everything in house. We're vertically integrated. Come take the ride with us. Yeah, we are not defining the properties that we're buying quite yet, but we just find a lot of these great deals, passively invest in this fund vehicle that we're going to have open for a year. And we're going to buy anywhere from 10 to 15 deals. We're probably going to buy 50, 60 units. And your risk is spread around a number of different deals in different towns, even though they're all within kind of like a 30-minute radius. So we typically try to mitigate that risk by leveraging, a portfolio structure of some kind with the capital that we're actually raising from LPs.
Gotcha. So you're building scale through a fund where you're packaging multiple properties together. You're getting some sense of scale through that. You're laying off some of the risk through the diversification there. Got it. And you've built a machine, like it says, where you're just buying at a good price, which allows you to take on a little more risk because it's built into the model. It sounds right.
A quick little thing too is we're probably won't do it forever. I think we'll try to become a business at some point in the next few years where we're buying those, larger deals predominantly. We just happen to be in that trajectory of our growth trajectory where we still kind of have to do these to build that investor base to go out there and exclusively focus on the big ones, which I should have mentioned, but that's a total aside.
Well, you're on your growth curve, right? But it sounds like you've built a great mousetrap for where you are. And I'm sure all that management experience that you're building now and being just so creative to figure that out is going to benefit you as you continue to grow and scale. So Axel, thanks for sharing so much info today. I think it was really interesting to learn about the Northeast, learn about how you're putting these small properties together into portfolios, learn how you're managing, how you're leveraging tech to build scale. I think a lot of good nuggets for our listeners. Before I let you go today, I want to take you through our keys to success round. There's 4 questions I want to ask you. The first one is, say you put your LP investor hat on, right? And you're getting pitched a deal. You don't know anything about the sponsor. You don't know anything about the deal. You can only ask one question. What is the one question that you would ask?
It's a good question. I think I would ask, tell me about a deal that went wrong and how did you handle what went wrong and how did you deal with it? I think that the reason I'm asking that is so many things can happen in a given deal and you can only underwrite so much as an LP. The one thing that you really want to feel comfortable with is that you're investing with a sponsor who has enough experience and has been investing for a long enough period of time to, 1, have had a deal go wrong, and 2, to have handled it in such a way that they can communicate it to you. Because at the end of the day, you can invest in the best deal, but if it's being operated by someone that either A, doesn't have the experience, or B, is just not going to act in a trustworthy manner when something goes sideways, it's just not going to be a deal you want to throw money at. Yeah,
you want to see that there's a level of accountability there too, right? Like they're gonna own up to it, and how did they deal with it? How do they solve problems? I love that answer. What are you most proud of in your career?
I think that in our PM company, we actually are in a position where we're impacting lives because we're actually, starting a business, right? It took me a while to actually become a real business owner in the sense that for the first 6 years of being an investor, we didn't have a PM company. It was really just me, right? I was a solopreneur. Once we started a PM company, we started hiring a large percentage more folks, I should say. And, we've got 22 employees in that business now. We have a lot of programs in terms of how we work with folks that work within our PM company to help them become actual owners of real estate, help get them into a house hack of some kind, in our local market. I do regular trainings, which is, I always laugh at the thought of this, but like I do regular trainings in our office where I'm like, here's how to become a real estate investor. Selfish benefit of everyone has an investor mindset in our PM company, but I really try to gear them towards here's how you can become an investor as somebody who's working in a PM company, how you can leverage those skills to become an owner of real estate yourself. And I think we're really, focused on helping folks actually invest in terms of the people that work within our businesses, whether it's the Aligned Real Estate Partners business or Blue Door Living, which is our property management company up in New Hampshire.
Oh, I love that. I mean, creating jobs and just furthering the economy, and like you said, becoming a real business owner. Like investing in real estate is not that. Yeah. All right. What's a book that everybody should read?
Not a big book guy. I haven't read many books in my life, but the one that I have read that has really stuck out is the One-Page Marketing Plan. I think it's Alan Dibb, I think is the guy's last name, and maybe I'm messing that up. But the One-Page Marketing Plan is like, if you're just a business owner, and again, we're joking about it. I think if you own a real estate business, if you're a real estate investor, you're really in the sales and marketing business. You need to market to find deals and investors. It's going to require some prospecting as well in terms of going out there and finding deals, investors, and building the relationships required to continue growing your business. The One-Page Marketing Plan was like a really transformative book for me early because it helped me think like a sales and marketing guy instead of like an Excel real estate guy. And I think that was a nice little mindset shift for me after I read that.
Yeah, I love that. I mean, I think I've heard the quote before, like, you're always selling, even if you don't think you are, right? I mean, every day, like to your kids, to your spouse, to, everybody out there. What is your number one key to success?
Narrow focus. We're like so narrowly focused. Like we buy real estate in a small little area in New Hampshire and we just do it extremely well. And I think specific to real estate, like you can become a very wealthy, real estate investor, you can grow a large real estate business in a small town with a narrow focus. And I'll, $10 million plus net worth, whatever you want to define it as. But you don't have to look everywhere. You don't have to buy every type of real estate. And I think especially for a lot of, whether it's LPs or active folks, they're so burdened by all of the possibilities, all of the different places they can pursue deals, all the different sponsors they could passively invest with, all the different types of real estate they could buy, markets they could buy in. We've had a really narrow focus for a really long period of time. And the only time our business has kind of stalled is when I've taken my eye off that ball. 2021, a lot of folks, I'm like, short-term rentals, that seems interesting. Maybe we should buy down in the Southeast. A lot of people are moving there. And that's when the ship kind of started to veer off course. Whenever we've been really just narrowly focused on what we're good at, the business has really been humming.
Got that. I think that's a great key. Stay focused, avoid the shiny objects. It can be difficult at times. There's a lot of different things out there to do, find, invest in. But Axel, thank you so much for coming on the show today and sharing all your wisdom. If folks want to learn more about what you're doing up there in Boston and in New Hampshire, then how can they reach out to you?
Sure. Email's probably the best bet. Axel, AXEL at Aligned REP. So short for Aligned Real Estate Partners, ALIGNED REP.com. It's also our website. And Multifamily Wealth Podcast, host a podcast where we're talking multifamily real estate all the time. So that's the other place in terms of staying in touch with what we've got going on.
I love it. Well, we'll make sure the website, the podcast, the book you mentioned, everything else is in the show notes so folks can access it. And with that, Axel, I hope you have a great rest of the day.
Appreciate it. Thanks for the invite. This was great.